If we're looking strictly at the headlines of the report that was released from the Ottawa Real Estate Board about what happened this month in the market, there's not really a whole lot surprising or interesting going on there. But don't go away. I do still think there's a good story here. It's just not going to be found in those numbers, which we're going to go through like we always do. But I think the more interesting story right now is what's going on in the Canadian economy more broadly, particularly when it comes to jobs. There was a Statistics Canada report that was released a few days ago, the monthly jobs report for August, that paints a pretty ugly picture. And I think it's important to talk about that and the impact that might have both on interest rates, which obviously has an impact on the real estate market, and also on consumer sentiment, which is another huge pillar that we don't often talk about, but is one of the biggest drivers as to what goes on in the real estate market. If people are worried about their jobs, they're not going to be out there actively looking to buy or sell real estate unless they have to. So I wanted to start off today by quickly looking at that jobs report before getting into the usual stats. Now, the first kind of headline number we're going to take a look at from the jobs report is the 66,000 jobs lost in August of 2025. Now, this is higher than pretty much anyone seemed to be expecting, so that is not great. July, we had a less severe loss, but still not great. And coming off of June, which was a fantastic month for number of jobs added, over 80,000, it was a little bit surprising. One thing to note about this uptick in June, where we added the 80,000 jobs, is during that same time period, youth unemployment actually ticked up. So the jobs we were adding were not the jobs that were needed for kind of young people. And that's something to keep in mind because a lot of the people that seem to be struggling the most, at least in my experience that I've been dealing with, are the first-time home buyers. People who have owned a place before, who have some equity built up, they're usually able to take the equity they've built up over the last few years, unless they bought like right at the peak, and get into something nice, whether they're move up buyers or they're downsizing. But first time buyers have been chasing the market for years, and this is not going to make it easier. If you're worried as to whether or not you're going to have a job in 6 months or a year, that's going to make it hard for you to want to take on the risk that comes with buying a piece of real estate and getting a mortgage. So again, this is just a couple of months of negative data, so it doesn't mean the sky is falling, but it is definitely worth paying attention to if we're trying to kind of forecast what's going to happen in the next year or so. The second key figure from the jobs report is, of course, the unemployment rate, which ticked up to 7.2%. So after things kind of stabilized over the summer, it even went down from May to June. Things have continued to go back up, which is what they've been doing since the beginning of the year. Not super surprising given the job losses that we saw, but something, again, to keep an eye on because the unemployment rate going up is definitely something that's going to have an impact on the market going forward. Now, as far as what this is going to mean, if you're someone who's considering getting into the real estate market in some capacity, whether it's buying or selling, is a couple of different things. The first one, as I already mentioned, is going to be the consumer confidence. Low consumer confidence generally translates to lower transaction volume, makes it harder to sell a house. If you're a buyer, it may mean less competition because other people are going to be worried about their jobs. So there's that to consider. There may be a decent window to buy something if you know you're in a sector where your job is secure. The other big impact it's going to have is interest rates. Now, I talked last month about the Bank of Canada benchmark interest rate and how we're kind of in that neutral zone right now between 2.25% and 3.25%. With the release of these job numbers, a lot of people are speculating that there's a good chance the Bank of Canada is going to drop rates in September. The next meeting is on September 17th, I believe. If that happens, it's probably going to be a quarter point, a half a point at the most. It'll still leave us within that neutral rate window where they're not really trying to stimulate the economy too much. And I think they probably are going to drop the rates. Even if they don't do it in September, most people are anticipating at least a drop or two. I think there's 3 meetings left this year. I'd be surprised if we didn't get to close to 2% by the time the year is out, if the job numbers continue in that direction. So this isn't necessarily going to directly translate into a lower mortgage rate for you, especially if you're looking at a fixed mortgage rate, as fixed mortgage rates are generally tied more to the bond yields. But if you're somebody who is in a variable rate mortgage, this is something that could have a positive impact on you. If the rates go down in the next few months, you're going to benefit from that in the form of lower rates and lower monthly payments. All right, moving on to the stuff that we normally talk about. In August 2025, the sales activity was up significantly from August 2024, up 12%, which is a huge jump. Again, keep in mind 2024 was a historically low sales year, but that's really encouraging to see. The number of new listings is up 8.6% and number of active listings is up 13%. So we're seeing more inventory hit the market and more inventory stay on the market for a little bit longer. But what's kind of surprising based on these higher amount of active listings and new listings is the months of inventory has actually stayed steady at 3.2%. So what that's telling us is basically that even though the number of listings is increasing, demand in general in the Ottawa market as a whole is keeping up with the supply. List to sales price ratio is 98%, so most places are selling a little bit under that asking price, which has been the case for most of the year. Median days on market crept up slightly from 24 days to 28 days. As far as detached properties go, we're looking at an 11.5% increase to sales volume compared to August 2024. Number of active listings and new listings have went up 5.1%, 2.3% respectively. Months of inventory has gone down to 3.1, which is encouraging. It means they're moving a little bit faster despite the higher inventory levels. Average price has gone up 4%. List to sales price ratio is 98, and the median days on market has not changed at all at 23 days. The townhouse sector continues to be the bright spot in these market updates. A 28% increase in sales volume is significant, even though August 2024 was a slow year. Again, I always feel like I have to mention townhouses in the context of the CREA stats always means condo townhouses and freehold townhouses. Big increase in sales volume there. Number of new listings was up as well, up 30%. Active listings was up 51.7%, which is crazy huge. So we've seen a huge amount of inventory hit the market. Months of inventory, probably because of that huge increase in active listings, has crept up from 2.1 to 2.5. But we're still under 3 months. So under 3 months means we're still in a technical seller's market, not as much of a seller's market as we were last year, but these products are still moving pretty quickly. So if you're priced well, you're probably going to be able to sell your townhouse. List to sales price ratio is pretty similar at 98.3, and the median days on market has gone up to 27 from 22. This is largely, I would assume, being dragged up by properties that are priced incorrectly and have been sitting on the market for a longer period of time. Moving on to the apartment condos, which has been the worst part of the market update for pretty much all of 2025. Sales activity is down 15.5%, even from an already low baseline number of 2024. This is kind of interesting. So the new listings, even though they are down 8.6%, there were fewer listings that hit the market in August this year than last year. There are more listings that are staying there, that are on the market at the end of the month, which means that they're not selling quickly at all. Months of inventory has climbed considerably to 4.5 months, up from 3.7. So we are firmly in balanced market territory now. Anything between 4 to 6 months is considered a balanced market, up from 3.7 last year. Average price is down 1.3%. And sales to list price ratio is down slightly from 97.2%, which means you can probably negotiate yourself a slightly better deal than you could last year on a condo. Median days on market is 38, up from 35. So at the end of the day, while there is definitely some bad news with the jobs report, things are still creeping up compared to where they were last year as far as price and sales volume, unless you're in that condo sector. It's not the worst real estate market we've ever seen. There's some concerning trends as far as what's going on in the economy. I think because immigration has also slowed down quite a bit, the policies have changed over the last few years. We're going to see less on that demand side of things as well. I think we're going to see a continued softening of the market, but that can change depending on what goes on in the economy in general and what goes on in the world. And as we all know, that can change pretty quickly, week to week, even day to day, it feels like sometimes. The advice I give people normally remains the same. If it's the right time in your life to make a move, whether it's buying or selling or getting into the market for the first time, and you're planning to hold the property for a longer period of time, it's not a bad time to do that. You just have to strategize properly, particularly if you're on the selling side. If you're a buyer, there may be a bit of a good window here for you to negotiate yourself a good deal, but don't buy with the intention of selling in a few years. You may want to be able to hold on to that property a little bit longer in case the economy does get rocky. The stats tell us that over the long term, real estate in Ottawa does well, but there's really no guessing at what it's going to do over the next few years. I hope you found this video helpful. If so, please consider liking and subscribing so it finds its way to more people like yourself, and so you see these market updates as they come out every month. Thanks so much for taking the time to watch, and have a fantastic day. Take care.